All right. Hi, everyone. Thank you for joining us this afternoon. I'm Jill. I'm a senior associate at Capital Factory. I work primarily across our accelerator and our venture fund. So for those of you who maybe this is your first event that you've done with Capital Factory and you're not as familiar with us, we are the center of gravity for entrepreneurs in Texas. So we are first and foremost a venture capital firm. We invest in early stage technology companies based in Texas. And outside of the venture fund, we do many other things such as events, co-working, and we also have an accelerator program. And according to PitchBook, we're the most active early stage investor in Texas since 2013. But really, we believe that Texas is the most promising technology investment opportunity in the US, and we want to be the ones to turbocharge it. So this all started with our CEO, Josh Baer, when he wrote the Texas Startup Manifesto. If you have not read it, you should. Just Google Texas Startup Manifesto. It'll be an awesome Medium post. Highly recommend reading it. So Texas is home to 4 of the 11 largest cities in the US, and they're all within driving distance of each other. So this is Austin, Dallas, Houston, and San Antonio. And as a standalone economy, Texas would be the 10th largest country in the world with a GDP of 1.6 trillion. So that's probably where a bit of our Texas pride comes in, if you haven't noticed yet. And more than 50 Fortune 500 companies are headquartered in Texas, and 6 of the Fortune 50 are here as well. So our goal is really to connect Austin, Dallas, Houston, and San Antonio, and the rest of the state into this massive Texas startup megatropolis. So hopefully that we can unlock billions of dollars in capital and unleash thousands of diverse entrepreneurs. And with that, I'd like to bring David Matthews to the virtual stage.
Hi, Jill.
Hi, David. Great to have you here today with us.
Great to be here.
Wonderful. So just for those in the audience that are not as familiar with who you are, do you mind just giving a brief background of yourself and your journey to becoming a managing director at Webtech Ventures?
Sure. Well, I was an entrepreneur in the 90s, had a local startup in Dallas that started and scaled really quick. And then I exited that company in the late 90s and transitioned into venture capital. And I've been in venture capital about 20 years. For the first 5 or 6 years, working for another firm and learning the business. And then from then on with my own firms.
Very good. And so as you mentioned, you've been on both sides of the table as a founder and as an investor. How do you think that your time as a founder has shaped the way that you make investment decisions as an investor now?
Well, big time, Jill. For one thing, it's pretty easy to get in the moccasins of an entrepreneur because I've been there. And I've lived through, starting a company with $9,000 that I got, from an insurance company for my car was stolen. So my first seed capital was $9,000 from a stolen car.
Probably glad the car got stolen.
Scaled from startup to over 20 million revenue over 6 years. So it was a pretty wild ride.
Wow, for sure.
So I can definitely relate to entrepreneurs that are getting on that rocket ship and know what they're going through.
Absolutely, to have that empathy, for what they're going through on a day-to-day basis. And so you had previously founded Intellicon, which is a Dallas-based audiovisual services company, and you and 2 co-founders had grown that from 0 to over 22 million of annual revenue. And that was between 91 and 98. And then in the beginning of 94, the company was recognized in the Dallas 100 awards for 5 straight years, which is very impressive, and also recognized in the Inc. 500, which is something that a lot of companies can't say that they did. So tell us more about Intellicon, how you chose to finance the company, and when you knew that it was the right time to exit that venture.
Well, I told you about the financing. My car was stolen. I got a check for $9,000. What I didn't tell you is what we did with that $9,000. We went and shopped at the bankruptcy auction of a competitor in 1991. We were going through a recession then. And by the way, recessions are great times to start businesses. So today should be pretty promising for everybody starting something. But we shopped at a bankruptcy auction, and I want to say bought $150,000 to $200,000 worth of audiovisual gear for that $9,000. And then overnight, we were in the events production business, and our forte was doing product launch events and user conferences for software and technology companies. But we also did a lot of work with retail companies. JCPenney had just relocated from New York to Dallas, and we did a lot of work with them as they did a lot of relocation events, shareholder events, employee events, and they built out this whole palatial corporate headquarters up in Plano, which is really ironic because it's nearly vacant now. But anyway, we scaled that company by just working harder than the other guys and always reinvesting our profits into growing the business. And you asked also in that question about how I knew it was like time to leave, and that would be
right time to exit.
What's that?
When it's the right
Yes,
time to exit, yeah.
Yeah, so I had watched our revenue for doing these users conferences for one of our big customers, which was Sterling Software. They had increased their annual spend with us for their users conference from like 10,000 to 100,000 to 250,000 to $500,000 to finally in '98 they spent $1 million for this big giant event with Colin Powell headlining in San Francisco. And like, man, oh man, it just gets bigger every year. But then when they started planning their event for '99, they cut the budget back down to 100,000. I said, oh, well, maybe some of the sizzle's going out of, having the latest, greatest audiovisual presentation for your users conference. So that's how I knew was when I saw the customers trimming back. Yeah. And also we had a competitor who had gone public on the New York Stock Exchange and was beginning a pretty aggressive acquisition spree. And we were hopeful to be part of that spree. It didn't pan out, unfortunately, but that was another signal, was there was material exit opportunities appearing.
Very good. And so in terms of the financing for the company, I know you mentioned that you had the 9,000 from the stolen car. I don't think many people can say that that was the money that they used for their first venture, but did you guys raise any other private funding at all?
Yeah, when we were at 8 million revenue and on our way to scaling to the 20, we raised 6 million of venture capital. Gotcha. And that was the only real serious growth capital we ever took.
Okay. Wow. Well, very good. And as a founder, did you participate in any incubators, accelerators through startups? And as an investor, how does a startup's involvement in an incubator accelerator impact your investment decision, if at all?
Okay, well, that's packed. You asked two really big questions.
Yeah, it's a loaded one.
The first one I'm kind of embarrassed to answer because, I started my first company in 1991, and to my knowledge, there was no such thing as an incubator or accelerator at that time. Something came along a little later that was funded by the 16th floor venture firms like Seven Rosen and Centerpoint. It was called StarTech Funds or StarTech. It was kind of an incubator and seed fund, kind of like an accelerator. But I don't think that came along till the late 90s. So there was nothing there for me, Jill. Sorry.
No worries. And what about for portfolio companies or companies that you're potentially looking at investing in, ones that have gone through incubators or accelerators? Does that, maybe influence your decision at all if they, have a good name behind them? Or do you just tend to stay away from those, or maybe it doesn't impact your decision at all?
Well, this is your prior question, right? Of do we like finding companies out of accelerators or incubators?
Yes.
Yeah, absolutely. I'm manage a very small micro VC fund, less than 20 million of capital under management. But I like to kind of joke that we have kind of the same workload as a firm that might have 200 million under management, just lob a zero off of every transaction. Right? So I value accelerators and things like Capital Factory immensely because it's this whole vetting process of kind of scouring the earth and finding the opportunities. And vetting them and kind of working with the best of what you find, and then all the coaching and mentorship that goes into it. So I value it a ton because we have to fish wisely. We have to fish in ponds where we're going to find the right fish. If that analogy is fair, I hate to liken entrepreneurs to fish. But
no, big
accelerators, Capital Factory helps immensely in that.
Yes. Oh, good. And I'm sure you've seen 1,000 pitches over your career. What has been, pardon?
At least.
At least, probably more.
500 a year by my count, and times 20 years. So
tens of thousands. Yeah. I've only probably seen 1,000. So what has been one of your most memorable pitch meetings, and what components of the entrepreneur's presentation stuck out to you most?
What's been the strongest pitch?
Just maybe one of the most memorable ones that maybe perhaps you guys decided to invest in or didn't invest in, more so trying to get at, what elements of a company or opportunity do you value the most, when entrepreneurs are presenting their companies to you?
Yeah, well, I guess the type of pitch that really gets me is when I hear a value proposition that really sounds powerful, like it sounds like it's solving a major problem, and providing like a 10 times better solution for a fraction of the cost. So I think seeing that kind of solution laid out, and then seeing that the team has domain expertise to potentially pull it off, those are the two things that really get me excited about deals.
Yeah.
So good. Thinking of a recent one, like when I met Kirsten Gaines through Capital Factory, actually, she was starting a startup called Pressed Roots, which was like a dry bar solution for women with textured hair. And she was like the epitome of her own customer. She'd had major problems with having her hair straightened over the years, and that's just the style she prefers. And she just had, nightmare quality of range from, excellent to good to terrible, and even lost her hair a couple times over the years. So I could really relate to the value proposition, and it really struck me that she had the right idea and she was the right person to pull it off at the right time.
For sure. And I've seen her pitch, and she's, fantastic, when she's presenting her company. And it's very true. As you said, she is her customer. She knows what, the customer wants and needs, and she's experienced it for years herself.
And she's hitting it out of the park with store number 1 at Trinity Groves, even through a pandemic. So I can't wait to see her scale this out to 100 stores over time.
Absolutely. Hey, we all have to get our hair done, despite the pandemic. And so you've been investing in companies for over a decade now, and you have had many successful exits under your belt, too many to name them all. And so you can really invest anywhere in the US or in the world. I'm curious, why you're excited about Texas and why you choose to invest here. I know that you guys have portfolio companies all over the US, but, a solid majority of them are in Texas. So curious to hear why you chose to invest here.
Well, I got my first job out of college here in Texas, and then I met my wife about 3 weeks after moving to Dallas. So I'm pretty locked into North Texas.
She kept you here.
But my experience, Jill, is all really in retail and technology and investing. And the beauty with Webtech is I get to put all three of those things together: retail, technology, and investing. And Dallas is perfect because why are there so many retail chains headquartered here? Albeit most of them are struggling now, and a few are even bankrupt now. But there's so many retail chains here because this is like a perfect place to test and launch a new retail concept and scale it out. Which is a little different now because you usually create stores online now and not a physical storefront. But we're still that place because where was Neighborhood Goods born? Right here in Dallas, not New York and not California.
For sure. No, Neighborhood Goods is an awesome store. They just opened up one on South Congress in Austin. So.
Yeah, have you been?
Yes, I was able to go right before the pandemic hit. And
they opened like the day before the pandemic closed.
Oh, I know.
You were there for opening day.
Crazy times. But they're in a great location. They have the Equinox right above them. They have a Sweet Green that just actually opened up today that went to the right of them. So they're in a great location and love their products they have there.
There's a great example of an entrepreneur. This is the only deal I can remember where I got pitched and I committed to invest at the very same moment.
No way.
Usually I have to go deliberate a little bit, but
yeah.
When Matt Alexander came in and it was still like a concept on paper, when he presented it, I'm like, that is the perfect concept, and you are the perfect person to launch that concept.
Oh,
it was just so crystal clear, and I think it's correct.
Well, I mean, they're doing pretty well right now, and I'm sure their online store is thriving a bit more than the in-person ones right now. But
More than they intended. Yeah.
yes, more than they intended, I'm sure. And so, a few questions that I've been getting recently is, and I guess just, opinions that are floating around, especially at a time like this, is that, I've been told by founders, especially, pre-seed and seed stage founders, that there's just not enough capital to go around in Texas, especially with startups flocking here. And there's not as many firms here just yet. So I'm curious to hear, what are some of the misconceptions about fundraising in Texas that you've heard, and how do you respond to a founder that is perhaps having trouble fundraising in Texas?
Well, I think Jill, Texas is actually robust for formation capital, for like that pre-seed and seed stage. Where we've lagged for the last 10 to 15 years has been with the growth stage capital, like Series A, B, and C capital. And then we get robust again when you get into private equity, when you talk about later stage growth capital. But in that kind of early to mid growth capital, we've really struggled ever since Austin Ventures went away in Austin, and although it's much less of an issue in Austin, we had all the major firms in Dallas go away in kind of between 2005 and 2010. So it's taken a really long time to replace that growth capital foundation. And it's because institutional investors kind of wrote off middle America as a place to allocate, pension fund, endowment fund money, and really focus their capital on the coast. But I think it's slowly coming back. But I would say for entrepreneurs, formation capital is great here. And then as you get to like where it's Series A, you have quite a few firms in Austin and a few in Dallas and Houston. So there is some, but if you've really got momentum and growth, it can actually be good for the entrepreneur to kind of grow in stealth through the pre-seed and seed stage, and then come on the radar of the big firms on the coast later. And if there's enough cause with team and product and market to really explain why Texas makes sense to grow the company, then the capital will come here, and it does. I mean, look at Theatro. They've raised tons of money, mostly from West and East Coast. The first customer was Container Store in Austin, and the company is right here in North Dallas. So
absolutely, and there's definitely more capital flocking here.
Sorry?
I said there's definitely more capital flocking here as well. Even what Jim Breyer just announced a few weeks ago, that he's relocating Breyer Capital to Austin. So, very exciting for Texas.
Smart move. Well, yeah, Texas is getting a trickle of talent from California, but Austin's getting a steady stream. So,
yeah,
congrats.
We're loving it. Once the Gigafactory is here, it'll be smooth sailing. So, we're excited about the influx of corporates and capital, and obviously startups that are coming to the state. So all good stuff over here. And kind of switching the conversation a bit to what's been on everyone's minds for a while is COVID-19, the pandemic, how it's affecting the startups and the businesses. And so, when the pandemic first hit, the venture market saw a dip post-COVID. And, so we're seeing slash valuations, and it's definitely an investor's world right now. I would probably say it was more of a founder's world, prior to COVID. So it's, harder for startups to secure capital here. And I know none of us hold the crystal ball or have all the answers, so to speak, but I'm just really curious to hear your thoughts on the venture markets post-COVID-19 and what founders and investors can expect in the next year or so.
Yeah, I can't speak for the whole market, but this is, for me, doing early stage venture investing, this is my third recessionary period. Right when I started in venture in 2000 through 01 was a recession, right as I got going. And then 08, 09 was a big recession. And this year's certainly been a recessionary type period with COVID. So what I thought about looking back on the last 2 recessions was it does take a little while for expectations to adjust on valuation. The market adjusts instantaneously because it's the stock market. But the venture market, I found, takes, a month or two while people kind of regather their thoughts about valuation and growth and path to exit. So we kind of paused on new investing from March through the summer, but we're getting active again. We've put out 2 term sheets this week, and I would expect us to do 2 or 3 more investments before the year's out. So I think, just speaking for myself, I think there was a pause for a few months, but I think we're getting pretty active again.
Absolutely. And I know you guys have your own thesis that was pre-COVID. Did your thesis change at all post-COVID, or, the types of companies that you were looking at?
No, the only part of our thesis that really got hit, Jill, was like in-store experience technology, because stores were closed, and that'd been a very small part of our capital. Most of our investment thesis was around automation and e-commerce and personalization, and we actually saw those themes accelerate this year. If you look at like the stock of Amazon or Shopify, they just went through the roof this year because online commerce is like 3 years ahead of where we expected it to be, thanks to this hibernation.
Yes, for sure. And so, investors tend to see a lot of these trends before many others do. And, personally, I've seen in the past few months a lot of telehealth companies and ed tech companies coming across my desk, mainly because people aren't wanting to go into hospitals. They're wanting, to be able to see doctors virtually or on an app. And then, ed tech. Millions of American parents were just thrown into, being teachers now. So a lot of ed tech companies coming across my desk as well. I'm curious, what are the market trends that you're seeing in this post-COVID world, and what trends are you most excited about that you think will continue, when hopefully COVID-19 ends, fingers crossed, very soon?
Yeah, I'm really excited seeing some more what I would call asset-light strategies around automated commerce, to where you can tag your way into a store with a QR code or with your mobile device and grab what you want off the shelf and walk away. It was early on, it was looking like a very asset heavy category that would require, giant mountains of capital to launch these things. And then kind of the same in another area we're interested in, which is re-commerce, which is that whole thought about sustainability of creating a secondary market for gently used products. Just like you've been able to buy new or used on Amazon seamlessly for years, it took a long time to get out to the rest of the market. To date, those things have been pretty capital intensive, like Rent the Runway and the Real Real. But now we're starting to see some things pretty interesting that are very capital efficient. And for us as a tiny fund, capital efficient is key. If it's going to take $1 billion to scale it, we're going to probably be wiped out by the time it gets to fruition. We like things that can scale with 10 million or less total capital.
Got you. Very good. And, so since the pandemic hit, we've switched to a virtual first world. We're meeting virtually. Normally this event would be going on in person. So a lot of founders and investors are having their first fundraising meeting over Zoom or other video conferencing platforms. And I don't know about you, but prior to the pandemic, I held the majority of my meetings with founders in person. And in my opinion, it was easier to probably have genuine interactions, maybe experience the demos of their product or services, a few other elements there. But do you have any best practices or tips for founders that are perhaps taking their first fundraising meeting in this virtual first environment?
I would guess, and I didn't think about this fully before the session, but I would guess it's more important than ever to find warm referrals into capital. I'm just thinking about 2 deals that we have that we're working on now. One is a founder that I've known for 6 or 7 years. So, the relationship was already there in terms of spending time in person and really getting to know the entrepreneur. And then the second one is referred to us through, really strong, trusted relationships. I would think a big part of the challenge is missing that ingredient of the face-to-face meeting. And a lot of investors really put a lot of stock in really getting a good feeling of camaraderie and alignment and trust with the entrepreneur. And I think that's obviously a step more challenging when it's a virtual meeting than an in-person meeting. But I just think the power of finding the warm reference, use LinkedIn to the max, I guess. Find that warm reference into the firm is probably important.
Got you.
It's always important, but it may be more important.
Yeah, absolutely. And so for founders who are listening in today that are perhaps wanting to get in touch with you, what is the best way that you recommend founders get in touch with you? I know, for example, Josh Bear, our CEO, says just tweet at him and he'll respond. How do you like to be contacted by founders?
So back to my last point, I shouldn't say a tweet or an email, right? I think if you look at the Webtech.Ventures website, you'll see 100 mentors and advisors on there. I think maybe scroll through those and look at one or two that you're directly linked in with or next level LinkedIn, and approach through that, because I get like anybody, I get like 200 emails a day, and in that there's probably 5 to 10 new investment opportunities, but it's just really hard to focus on those. I mean, they just relentlessly pile their way through the door. But when somebody I know that I have a relationship with, that's one of our mentors or investors or advisors, I'm gonna hear them and say, yes, I'll take a look at that. Please connect me.
For sure. All right. So warm referrals. Got it. And you've been starting, investing in and mentoring companies in Dallas and all around the US for some time now. I'm curious, from your perspective, how has the startup and entrepreneurial community in Dallas evolved over the years, and where do you see it perhaps in the next 5 years?
I'm really hopeful with your Texas Manifesto with Capital Factory that you're going to create this seamless integration between DFW, Austin, and Houston. Because I would love for 100% of what we do to be in the Texas Triangle. And we currently, like I told you before the call, most of our investments are in DFW, Austin, West Coast, and kind of New York, New Jersey area. And I would love to do everything here, but being thematic with retail tech and new retail, we have to kind of look more widely. So the perfect world would be we just eliminate the distance between Dallas, Houston, and Austin, and can put capital and entrepreneurship together. For sure. Great. Well, that's all the questions I have for you. So with that, I'll open it up to questions from the audience. We have quite a few questions coming in. People are very curious to hear your opinions and advice. So the first question that we have says, what fundraising advice would you give for nonprofit startups? Well, you got a terrific not-for-profit accelerator here in Dallas, the United Way's ground floor. Is a great launch pad. But I would say it's probably similar advice to a for-profit. You have to have a powerful value proposition that disrupts the marketplace with having something much better than what's been previously available. And I think a real focus on who your absolute target customer is or recipient of what your not-for-profit does, and not too wide of you. And so these are all kind of the same thing, and as a for-profit, and also to be as frugal as possible, to where you can get to where capital's an option more than a requirement.
For sure. I know there's a variety of grants that are offered for nonprofits as well through, local government or even federal government. So it could be also another option to look into as well. The next question we have is, what are some verticals that fall under retail tech?
Oh, well, yeah, you could take almost any kind of new tech, AI, augmented reality, virtual reality, blockchain, Internet of Things. You can take any of those themes, and there's applications in the retail spectrum for them. But the verticals in retail really kind of fall between what's called online, which is shopping online, and offline, which is shopping in physical stores. And then the harmonization between those two. When it used to be all offline, right? If you wanted something, you had to go to a store or maybe shop through a catalog, mail order. And then online came along 25 years ago or so. And then all the retailers started creating a separate business for the online part. And then over the last 5 years or so, they've all realized that it has to be an integrated business. It can't be like a separate business unit. Because you want the customer experience to be excellent and uniformly great, whether they're shopping on mobile or on desktop or in a physical store or some combination. So I think the categories really fall between online, offline, and harmonization of online and offline. And then the various technologies that have use cases that are really strong in the retail spectrum. And when I say retail, I really include brands too. So like consumer packaged goods and consumer brands in general.
Absolutely. The next question we have is, if not involved with an accelerator and in this crazy COVID time, how do you create a network and find mentors to work with?
Well, I think there's just like an incredible ton of events to participate in, like the one we're in right now. So I think all of us have to be seeing dozens of those opportunities. So choosing wisely on those where you feel like it won't just be like watching television, but there will be an interactive component where you can connect with some of the other participants. And I guess this is an example of that, right? I know y'all got me for office hours after this for a couple hours.
Yes, we do. We're able to snag some extra time on your calendar, but no, for sure. I mean, I think there's more virtual events now than ever. And
but there's another thought too that I've been thinking about is everybody has some kind of expertise or connection to expertise or something that other people would like to learn about, to frame up like a salon or a session like this around your area of expertise or around a topic of interest that would attract an audience. I think it's a great way to be like show thought leadership. And then if you're producing the event, just say you have, something that you're really good. Like Kirsten could do a session on hair treatment for women with textured hair. You get an audience of dozens or hundreds or even thousands, and then you own, that audience, all those connections, and you have, reference as a thought leader with that group. So I think everybody could, to some degree, be framing their own sessions around areas of expertise, and that seems interesting.
For sure. And I know there's, that most events are virtual now. We actually have more events that we can attend and more access to these opportunities that perhaps were, only in person before. So if, Capital Factory in our Austin office is throwing events, people from Dallas and Houston, it's, really a pain for them to drive on over, but all of our events are online now. And so I think there's more events that you can attend now than ever. And ones that also do have those engaging components. For example, right now I'm asking, the speaker's questions. So all good on that front. The next question we have is, please discuss angel investors' expectations for retail startups. What is the right avenue to take VC versus angel money?
Well, I think there's a lot of things that go into that. I think there's a lot of businesses that could get off the ground and scale and actually be customer funded business and maybe not require any capital. And that is ideal. It's free of dilution of any kind. I think there's also types of businesses that can launch and scale with a very small amount of capital. And if the amount is, say, $1 million or less, it's likely that angel is a better path for that. I think back to investing in Order My Gear here in Dallas in 2013, 7 years ago. They were a startup already doing, about, I don't know, maybe 100,000 a year of net revenue, providing e-commerce avenue for school teams that are outfitting the teams, and we were able, out of our accelerator, we were able to get them funded with, I think, $650,000 of angel funding, and they took that funding and they scaled the business to over 20 million net revenue by the time we exited 5 years later. So there are types of businesses that can scale that don't require much capital, and angel may be a better route there. And then there's businesses that really, have to go fast because there's a lot of, competition heating up and it's a hot market space. And you really have to scale quickly and build up team and develop your product at really a very accelerated pace. And that certainly is, requires venture capital, whether it's getting angel capital first in a pre-seed round and then venture in the next round, which is common, or just going straight to venture from the outset, which is more challenging.
Okay. Yeah, I know it's kind of a loaded question. There could be a lot of variables there. The next question we have is, how long should the first pitch and virtual meeting with an investor be? Should the CEO be present or all the co-founders as well?
Oh, on that, I would for sure say all the co-founders to have like the key core team together, because even in a virtual meeting, hopefully the investor could see the synergy between the founders of the startup, and that's definitely what we're looking for. A single founder is really tough to generate early scale, so you want to see 2 or 3 co-founders. And that, I think that first meeting, you're really getting just that first impression and getting your head around the value proposition. So I think the whole team is ideal. So the investor can kind of see that synergy and complementary strengths between the team members versus just a broadcast from the team leader.
Yes, for sure. And last,
was there more to that question, or was that the primary?
No, that was the primary question. Okay. Yes, thank you. And the next question we have is from Shady De Jesus. She asks, what size checks are common, and generally how far are companies along when they get the yes?
I think that probably varies a bit with every firm. What is it for Capital Factory, Jill?
Average check size for us is roughly 150K, and on the lower end can be 50K or up to 250K. But we invest in seed and Series A phase. Yeah,
we're primarily pre-seed and seed round is our focus, and then we have follow-on funds that can do bridging and even into A and B rounds. But we really separate initial investment from follow-on investment. We make about 6 initial investments a year. The average check size is $100,000. The average round is $500,000 to $1 million. So we will typically write a $100,000 check. We'll bring probably another 100 to even more of co-investment, because the investors in our fund get a chance to invest directly in deals they like. So yeah, our initial check is usually 100, and we're usually helping to complete rounds of $500,000 to $1 million, with maybe 250 to 500,000 of investment from our syndicate. And our follow-on investments kind of range from doubling down to 2 to 3 million. And we do 1 or 2 of those a year, so kind of 1 in 5, 1 in 4 maybe.
Okay. Good. Well, Dave, I know you have office hours with our startups, so I want to make sure that we can get you there on time. But thank you so much for joining us. I know I personally learned a ton from this conversation, and selfishly love to ask all of the questions and learn from you. And I know our audience does as well.
Thanks so much for having me on, Jill, and thank you especially for expanding up to Dallas with Capital Factory.
Yes.
It's really been great to have Capital Factory up here.
Yes, for sure.
Really rebuild we kind of cleared the field 10 years ago, and it's been like seed planting ever since. And having you all come up here and help drive that faster has been terrific.
Yeah, well, we couldn't have done it without you all. And, our next Houston office is opening up in hopefully spring of 2021, and that'll be in the Ion in Houston. So, we're excited to give Houston a little bit more love as well.
Yeah, awesome.
Wonderful. Well, thank you, David.
First place I lived in Texas. My first year in Houston.
Oh, quite a few of our founders actually came from there, and the founders of Capital Factory as well. So we love Houston and definitely want to turbocharge it. But thank you again, David, for your time. We'll get you off to office hours with our startups. And, for those of you that were listening in that, enjoyed this event, there's a ton more waiting for you at capitalfactory.com/events. And we hope to see you at the next one. Have a good day, everyone.
Great. Thanks very much, Jill.
Thank you, David. Bye-bye.
Bye.